Looking to get started on building your credit post-bankruptcy? Or perhaps you're considering bankruptcy but aren't sure of the journey to look at when it comes to building your credit? Well, in this video, I'll guide you on the things you need to know when it comes to building and fixing your credit after bankruptcy, especially now. So stick around. Hey, what's up everybody? Ali Director back with a brand new video. If you're interested in leveling up, fixing, and using your credit to build wealth, then consider subscribing to this channel and turn the bell icon on so every time I post a video regularly on this channel to help you get started and understanding the knowledge of credit to live a more prosperous and financially rewarding life, you'll be first to be notified. And with that said, let's get on to today's topic, doing credit repair after bankruptcy. So the big question is, how complicated or difficult is credit repair after you file for bankruptcy? And to be modest about the facts, it does take a few cautious steps in contrast to if you didn't have bankruptcy on your credit file to start with. I'm going to give you 3 things that you need to be on the lookout for. And seeing that building and fixing your credit post-bankruptcy requires diligence, it's important that you pay attention to these steps so that it'll help you avoid unnecessary hiccups along the way. So the first thing you need to consider is aggressively budgeting. And there's a good reason why I tell you this. You see, most people who are teaching about credit and fixing it post-bankruptcy are stating that there's other tricks and tactics that you can deploy. However, they forget a key ingredient, and that is that you have to demonstrate your ability for financial commitment in order to receive the adequate credit in order to build the credit over time progressively. Credit is simply not granted after a major financial deficiency on your credit reports. See, lenders and underwriters who are handling banking are looking at bankruptcy on a very cautious level. And this is especially true when you're asking for unsecured funding, such as credit cards. So in order to be able to build a confidence from lenders to be able to give you and extend credit to you, you'll need to demonstrate your ability to maintain financial discipline. And this all starts with an allocated budget that contradicts the traditional unsecured route and turns it into a more safer and secure option for banks and lenders to work with you. And this simply means that you'll need to get a series of secured credit options against your savings with a designated bank of your choice. And this leads us to our second point, the ability to diversify your credit profile. And to be able to do this, you'll need to create a structure which you'll be able to apply for installment loans and other range of funding products. And this is a must if you're looking to systematically scale your borrowing capacity for the future. So let's discuss some ideas on how you can do this. First, identify the vendors that have loan products that you can typically tap into that are not necessarily credit cards. A good example of this is perhaps getting a 12-month installment loan with a bank that you do business with. The trick is not to max out the loans to savings ratio. So an example is, let's assume that you have $1,000 saved up, at which point you can borrow $500. You simply ask the bank to use your savings as collateral or security in this matter and request a term without any prepayment penalties. When using this strategy, it's simple, and you're basically looking to pay that loan off in a short period of time, let's say 6 or even less, 3 months. So instead of waiting until the end of the term, this will allow you to then go back to the bank and ask for some amounts which are similar, but instead of secured, you can ask for unsecured this time. And chances are that it will approve you for it depending on the payment performance during that time. The important thing here is to make sure that you don't take out that savings of $1,000 until all the funds that you owe the bank have been paid back and there's no outstanding debts left towards that institution. And if you do this with 2 or 3 banks and deploy the same strategy, you'll be adding massive points towards your credibility and your fundability score. So your final and third point is to stack up savings to debt ratio. To do this, you'll need to calculate the overall amount of debt that you're carrying and at least save 2 times the amount at any given moment. So this obviously requires a great level of discipline, but it's 100% doable. Having a dedicated savings amount will provide you reassurance that you'll be able to meet your payment obligations for a few months in case something were to happen. This is extremely critical at any given point, and you'll be able to create a financial ratio to work with whenever thinking about onboarding new debts to carry. And remember, fixing your credit after bankruptcy requires discipline, vision, and acceptance. You need the discipline to provide confidence to lenders that they can trust you again. You need vision to build up a solid credit profile with a goal in mind. And you need to accept that it is a long-term game and cautious game. So the more you realize that, the sooner you'll be able to capitalize on the opportunity and establish something solid. So there you have it, the 3 things that you'll need to keep in mind when you're doing credit repair after bankruptcy. If you learned something and enjoyed watching this video, don't forget to give this video a thumbs up. Do you know someone who can benefit from what I've just shared with you today? If so, give me a yes in the comment section and share it with that person. And finally, if you haven't subscribed yet, well, consider subscribing so you don't miss another one of my videos. And don't forget to turn the bell icon on so that you're notified when a new video is released. This is your guide and mentor, Ali Tarafter. Catch you guys on the next one. Bye for now.